Hello, everyone, and thank you for joining us. My name is Laurel Page, and I am the Assistant Director of Events at the University of Colorado Boulder's Leeds School of Business. Welcome to our 8th webinar series. These continue to be trying times, and here at CU Boulder, we have gathered our world-renowned faculty and alumni to provide frank and timely insights. Today is the third of 6 webinars in this webinar series. To view upcoming webinars, please visit colorado.edu/business/alumni, click the drop-down arrow and click Attend Online Webinars. For today's webinar, we're excited to welcome Ed Van Wesep and Brian Waters here presenting Why GameStop, Why Now? A Theory of All-in Investors and Unstable Asset Prices. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Ed or Brian, please send a question through the Q&A interface. We will monitor questions as they are submitted, and Ed and Brian will respond to them at the end of the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speakers. If you experience any technical difficulties during the webinar, please notify us through the chat interface and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants tomorrow, along with a survey link and supplemental resources from today's presentation. Now I am excited to introduce today's speaker. Van Wesep is an associate professor of finance. He earned a bachelor's degree in applied mathematics from Brown University in 2003 and a doctorate in economics from Stanford University in 2007. His research spans several areas of economics, including asset pricing, contract design, employee compensation, and microeconomic theory. He teaches graduate level economics courses in the Leeds MBA, Evening MBA, Masters in Finance, and Masters in Real Estate programs. Our second presenter is Brian Waters, an assistant professor of finance. He teaches investment and portfolio management at the undergraduate level and teaches a graduate level course in finance theory. He earned a doctorate in finance from the UCLA Anderson School of Management and bachelor's degrees in economics and in human and organizational development from Vanderbilt University. His research interests include corporate finance and microeconomics theory with a focus on the design of incentive and screening contracts. Welcome, Ed and Brian, and thank you so much for being here. Ed, I'm going to hand the controls over to you now.
Thanks so much, Laurel. I really appreciate the kind introduction and welcome everybody to the webinar. I think Brian and I are very excited to be able to present this hot off the presses research. The paper is called All-in Investors and Unstable Asset Prices. And I think a better title for the non-academic audience would be Why GameStop, Why Now? So I think probably most of you in the audience are already pretty familiar with the GameStop episode, but we thought we would just start with a few facts about that episode to familiarize everybody. So GameStop is a brick and mortar retailer of video games. And like most brick and mortar retailers of all sorts of things, clothing, dishes, whatever, they've been doing poorly over the last 20 years. The internet is putting the kibosh on a lot of, retail on the street. Now, what is unusual is that unlike most brick and mortar retailers whose prices have sort of been trending down until they get bought up by private equity or just shut down completely, GameStop had a little bit of a turnaround. So the stock price you see here is tracking from December 1st, 2020 to just a few days ago when we made this slide. And as you can see, in January, the price rocketed, and it rocketed really, really fast and somewhat unexpectedly. And I think this episode raised a lot of questions in people's minds as to why. What does it mean for the future? What does it mean about GameStop? Is it a one-off? What are regulators going to do? It raised a lot of questions. So Brian and I sat down to try to understand whether this was just a standard phenomenon that happened in the past, or whether this was maybe something new that we need to understand a little more deeply through new theory. So just a brief timeline of events. A couple of years ago, this handle, Roaring Kitty, started sort of talking up GameStop stock. A lot of other people did as well, but it really started here. And the argument was that the stock was oversold, simply meaning that, in the words of Planet Money, the company had a lot of cash, it had prospects, but it was treated by Wall Street as though it was bankrupt, even though it wasn't bankrupt yet. And that maybe the stock price didn't reflect the opportunities inherent in the stock. Now, Roaring Kitty is not the name of a normal person in our society. What is it? Well, Roaring Kitty is the handle of a poster on the subreddit Wall Street Bets. So a subreddit is just a forum where people can post things that they think, or memes or advice or arguments about stocks that they're interested in. So I'll just show you a little bit of what this subreddit looks like. And you can get a feel for the culture of it and how it relates to the topic at hand today. This first post, and we just grabbed these posts 2 days ago. This is kind of what it looks like every day. There's nothing special about these posts. The first post is somebody who says, sold my other positions to buy that juicy dip. And you can see the person has taken a screenshot of her or his buying history. And this person is going all in basically on GameStop stock. So sold my other positions to buy that juicy dip. And the person says, YOLO, you only live once. So let's take that big risk. You only live once. The next post right under it says, all in AMC, 100% of my portfolio. So this is somebody who's gone, quote unquote, all in buying AMC stock. And you see it says diamond hands. That means forever holding. So the person's never going to sell the stock. And then there's an ape. The people on this subreddit call themselves apes. There's sort of a little bit of mild self-deprecation in a lot of this particular subreddit. I say mild because I'm not so sure that most of the posters on it are particularly self-deprecating people in reality. You can also see that I've had to bleep out a word, and that actually is pretty frequent. I tried to find something where I wouldn't have to, and I couldn't. So here's another one. This is a meme that was posted right underneath those two. It says, sup apesters, Elon Musk's recent going to the moon very soon tweet was not a mere puff. So there's a drug reference. This is based on the thorough research done by his company Neuralink. They've come to a very interesting conclusion. And so here's a video of a chimpanzee playing a game where if it can get the dot in the square, it gets food. And you can see there are a bunch of sort of captions that this Redditor has added to the video. This one says, for example, he starts to buy more when the price goes up. So what we gather is that people on this website, they like to have a little fun with it, but it's not at all uncommon for them to go, quote unquote, all in. It's not uncommon for people to buy more when the price goes up. And we think that this is particularly important for the GameStop episode for two reasons. And I'll get to those two reasons in just a second. Just to fill in the timeline a little bit more, in the summer of 2020, Ryan Cohen, who is the co-founder of Chewy.com, bought a large stake. And this was important because Chewy.com was a successful online retailer of pet food that was able to take what had been a retail industry that had been dying due to Amazon and other online retailers, build an online presence and succeed with that online presence. So his vote of confidence sort of backed up Roaring Kitty's view that maybe there was a stronger play here than people realized. In the fall, on that same Wall Street Bets forum, a short squeeze argument started to circulate. As you can see, the price now has gone up from $5 to about $15. And as that price rises, it causes trouble for a particular type of investor called a short. So what is a short? A short is somebody who borrows shares, sells them, hopes for the price to go down, because then the borrower can buy the shares back, return them to whomever she borrowed the shares from, and profit from the decline. It's the exact reverse of a long, who's somebody that buys, hopes for the price to go up, sells, and makes money on the increase. And what you can see in this figure is that short interest, so the number of shares sold short by people, was much more than the actual number of shares in the quote unquote public float, which is the number of shares that the public is able to trade back and forth. That's very high short interest, and this was something that got the investors on this Wall Street Bets subforum particularly interested in the stock. The idea being, if you can drive the share price up, then the shorts lose money. They either have to provide more money to back up their positions with additional collateral, or they have to close their positions. When they close their positions, the way they do it is buying shares, further driving the price up. So during the fall, there was an argument that these large short positions, if only the Redditors could get enough money together to buy shares and drive the price up, they could force a short squeeze, causing the price to go up further. And as you can see, that the short interest did go down substantially around that first surge in prices. Now, on January 11th, Ryan Cohen, that co-founder of Chewy, was appointed to the board. And that was really what set off this whole episode. So here's somebody who has succeeded in taking brick and mortar and putting it online. Now he is on the board, and the price starts going up to 40. By the 27th, it peaked over $400 a share. And this was that first spike that we showed you, and this is what got everybody excited. Now, here's where things really start getting interesting. On January 29th, Robinhood, Interactive Brokers, TD Ameritrade, pretty much every brokerage out there that dealt with retail investors restricted or halted purchases of stock and options of GameStop shares. They also stopped purchases of lots of other companies. We'll talk about AMC in a minute, and you saw AMC referenced in that earlier screenshot from the Wall Street Bets subreddit. So here, all purchases of stock and options in those shares were stopped by these retail brokerages. Now, those restrictions were subsequently lifted over the next few days. So just to sort of close out this timeline of events, why do we care that things were restricted on Robinhood? Why do we care? Well, first of all of the Wall Street Bets people, this is where they're trading. And for the most part, it's Robinhood and Interactive Brokers, maybe a few other places. But Robinhood in particular, you can tell by the name, it was created, it was founded to democratize high finance, to bring the opportunity to invest in sophisticated financial securities, just like the trained, highly educated, highly financed people do, to bring that to the masses. That was the concept of Robinhood. So what they did uniquely was allow people to trade stock options even with very little experience, or actually no experience at all, in finance. So let's just talk briefly about options. A stock option, again, without getting into too much of the details, but a stock option is a way to lever your position. Again, there are important details I'm going to leave out. If you know how options work, you're going to be a little frustrated by this. But for our purposes, stock options are a way to lever your position. So if you own stock options with a strike of 500 a share and the current share price is 200 a share, then if the stock goes up 10% in price, your options might go up 20 or 30 or 40% in value. And so if you really believe that the stock is going to go up a lot, buying options is a way to take advantage of that and lever your positions, to make a levered bet. Think about buying a house with 10% down. If your house price doubles, your money doesn't double, your money goes up 11-fold. The bank isn't owed any more money. They're getting that 90% of the original price. You get all of the benefit. So buying housing with a mortgage is a really good way to lever up your money if you think housing will do well. Similarly, buying stock options is a good way to lever up your belief or your position if you think that the stock will do well. So Robinhood made these options available, or made options trading available to retail investors with very little experience. Precisely the people who might be populating Wall Street Bets. Now, there are some sophisticated people on Wall Street Bets as well, but there are a lot of unsophisticated YOLOites as well, and now they had access to stock options in a way they didn't before, and that was due to Robinhood. Now, Robinhood gave people access to stock option trading. Did they use it? What we plot here is the daily return on GameStop shares, and you can see that the share price skyrocketed right here in late January. You can also see that in the blue is the volume of options with high embedded leverage. So that just means options that lever your position at least 2-to-1. And what you can see is that the volume of levered positions really skyrocketed while the price was skyrocketing. Now, this first dashed line shows you when Robinhood and others restricted purchases of stock and options in GameStop, as well as other shares. And you can see that both the price collapsed and the value of trading in levered stock options collapsed as well. And that suggests that the people who were trading these options were the Redditors. They were the people with Robinhood accounts and Interactive Broker accounts. These were not people who were professional shareholders. If professionals were trading, Robinhood stopping its account holders from trading would have been completely irrelevant. That doesn't really matter. But if it's the individual Robinhood account users who are trading, when they are restricted from trading, now they don't do it anymore, and the volume of these stock options traded collapses. Now, it's not obvious that these two should be related, levered options trading and the stock return, but our model is going to show you how that they might be connected in practice. We'll just make a final point here before I turn it over to Brian, that actually, while this price increase was most prominent in GameStop, it was not unique. So this is the aforementioned AMC. As you can see, they experienced a stock price on just the same day. So the fact that the Chewy co-founder was appointed to the board of GameStop, that has nothing to do with AMC, but it saw a similar price increase on that day. Similarly, it saw this additional price increase later, which GameStop did as well. And as we'll see, this later increase has nothing to do with a short squeeze. Short interest was low before, it was low during, it was low after. And so when we look for answers as to why these prices have risen so high across multiple stocks with different storylines, again, the co-founder of Chewy being appointed to the board and not, a short squeeze doesn't seem to be the whole story, and it seems to cry out for a new theory. And I'll just leave aside for a second Bitcoin. We can come back to that a little bit later, but in interest of time, I'll just mention that the idea that short squeezes alone are the explanation for high prices. I think, especially with this second surge, it's a little bit iffy as a sole explanation, but it might be part of the explanation. So what we're going to do is offer a different explanation to you now. And with that, I turn it over to Brian, and I'm going to stop my share.
All right. Well, thank you, Ed, for detailing the GameStop episode. I am now going to attempt to provide an explanation for why stock prices have skyrocketed, in particular in GameStop, despite little to no change in the fundamental value of GameStop over this period. So as Ed mentioned, a common explanation was a short squeeze in GME, and that's GameStop and AMC. However, as we saw in the earlier chart, the short interest was greatly diminished during the most recent surge in the price of each of these stocks. And so we need an alternative explanation that perhaps can explain why prices still remain high or continue to increase in these two assets. And so the explanation that we're going to give is that we believe that prices can spiral upwards and potentially out of control when two facts are true. When some investors are all in, and by all in, we mean they buy as many shares as possible given their available wealth. And when these investors use borrowed funds to increase their buying power. So they can borrow funds directly from their broker in terms of margin trading, or as Ed said, they can use options trading in order to have embedded leverage to lever their position and to increase their buying power. And when these two features happen together, we can get price spirals. And the way in which we get price spirals is as follows. So when traders purchase shares using borrowed funds, that was our first feature that we need, their wealth is going to increase faster than the increase in prices. So we'll see an example of this on the following slide. But for example, if you borrow funds to purchase additional shares, then when the price doubles, your wealth is going to increase more than 2 for 1. And in the example that we have, we're going to see your wealth increase 3 for 1. So when investors use borrowed funds, their wealth increases faster than prices. If these traders are also all in, that is, they buy as many shares as possible, then the demand for shares is also going to increase when prices rise. So prices rise, these investors become wealthier than they were before, their wealth increases faster than the price. And so if they reinvest this additional wealth back into the stock, then their demand for shares, the number of shares that they buy, is also going to increase when prices rise. And this is going to lead to a feedback effect or to a spiral where prices can continuously rise over and over and over again. And the logic is as follows. A rise in prices, because these investors are all in, leads to an increase in demand. If you think to introductory economics, typically an increase in demand leads also then to a rise in prices. And so these two forces feed back into each other. A rise in prices leads to an increase in demand. An increase in demand leads to a rise in prices, and so on and so forth with no end in sight. All right, so that's the simple intuition for what we have in mind. But in order to kind of formalize this idea of a price spiral, we're now going to work through an example or a more formal model. So suppose that we have an exuberant all-in investor whose demand for stock, we can think of it as being GameStop, is limited only by his wealth of $600 and a borrowing constraint or margin constraint that he can invest up to double his wealth. So our investor has $600. When he has $600, he can borrow up to an additional $600. If he does so, he'll then have $1,200 with which he can invest in shares of stock. Now suppose that shares of this company trade at $100 per share. Since our investor has $1,200 with which he can invest, he's going to then purchase 12 shares of stock. To continue our thought experiment, suppose that the price of these shares now doubles from $100 a share to $200 a share. Because our investor owns 12 shares of stock, this means that the value of his shares increases from $1,200 to $2,400. Now, the question we want to ask is, how many shares will this investor purchase now that the price has doubled from $100 a share to $200 a share? Remember, he has 12 shares that are now worth $2,400, $200 a piece, but he borrowed initially $600 from his broker to invest in those shares. And so he needs to repay the $600 back to his back to his broker. And this means that his wealth is the $2,400 that he has in shares minus the $600 that he needs to repay. And so the value of his portfolio, the total wealth that he has, is $1,800. And this brings us back to our first fact. So when investors borrow in order to increase the number of shares that they can purchase, their wealth increases faster than the price. So in this example, the price doubled from $100 to $200, but our exuberant all-in investor, his wealth increased threefold from $600 to $1,800. And this is the first piece now of a price cycle. The second piece is that we need this investor to be all in. This investor wants to reinvest his additional wealth back into the shares, into additional shares of stock. So this investor now has $1,800. Being all in, this investor borrows against his new wealth. He can borrow now up to $1,800. That means the total amount of money that he can use to purchase shares is $3,600, 2 times 1,800. Each share now costs $200 per share, and so this investor now wants to buy 18 shares of stock. This is 6 more than this investor had before, and this is the second piece now of our price cycle. Because this investor borrows and because this investor is all in, when the price doubles from $100 to $200, he buys 6 additional shares than what he owned prior to the price increase. And there's nothing special about the price doubling from 100 to 200. What happens if the price instead triples from 100 to 300? Well, in this case, his 12 shares are worth $3,600. He borrowed $600 from his broker, so he needs to repay that $600 back to the broker. This means that his wealth in this case is $3,000. Here, the price tripled and his wealth increased 5-fold. Again, we see because this investor used borrowed funds that his wealth increases faster than the increase in the price. Again, if this investor is all in, he borrows against his new wealth. He now has $6,000, which he can use to invest. Shares cost $300 per share. And so now he buys 20 shares, 2 more than when the price doubled. So interestingly, this investor has what we call upward sloping demand. That is, he buys more shares when the price is higher. And this is interesting because in almost every setting, we think that demand should be downward, not upward sloping. So for example, if you go to the grocery store and apples are more expensive, you're going to buy fewer apples. If you go to a department store and shoes become more expensive, you're going to buy fewer shoes. If we charged you for this webinar and webinars became more expensive, you would watch and buy fewer webinars. And the same thing should be true for stocks. Typically, when stocks are more expensive, investors are going to buy fewer shares of stock, not more shares of stock. So the combination of using leverage, of borrowing or buying options, and this all-in behavior, the desire to reinvest your profits when prices rise, gives this peculiar, atypical, upward sloping demand. Now, if only one or two investors have upward sloping demand for shares, that's probably not going to have any noticeable impact on the stock price. But if many, many investors have this feature, they have upward sloping demand, they're all in and they use margin, then it turns out that prices can spiral out of control. And this is how we get the feedback effect, where higher prices lead to more demand that leads to higher prices, and so on and so forth. And what this means is that coordination among exuberant investors is of primary importance. And this is why GameStop and Wall Street bets are fundamental features of this episode. The fact that these disparate small investors who all have exuberant beliefs about the price rises in GameStop all decided to focus on a small number of securities is really what makes this theory tick and what we think allows prices to rise in this fashion. All right, so in order to now illustrate formally how a price cycle can happen, we need to flesh out the model a little more. And by model, what I mean is what we're going to do is we're going to show demand for assets among investors. And we're going to think about the supply or the available assets that are out there for investors to buy. And in an equilibrium, we want the market to clear. We want to know when and at what price will demand equal supply. And this is the price that we think will arise in the market. So in context of demand, not all investors are all in. Some investors buy and sell based on a stock's fundamental or fair value. And in the context of the GameStop episode, we could think about Melvin Capital as being one of these investors. Melvin Capital was the hedge fund that was prominently short during the short squeeze and lost a fortune as prices were rising. So what do these investors do? They buy when they think the price is below the fair value, that is, they think the price is too low. And they sell when they think the price is above fair value, that is, the price is too high. And presumably, this is what Melvin Capital was doing in January. The reason they had a large short position in GameStop was because they thought the fair value of the asset was much lower than what the price was. And so they're taking a very large short position. They're trying to sell as many shares as they can. And it turns out that if you behave this way as an investor, if you're a value investor, as we'll call you, then you have typical downward sloping demand. As I said on the previous slide, normally we think that consumers and investors have downward sloping demand. If you behave as these value investors do, then you too will have downward sloping demand. You'll buy fewer shares when the price is higher and more shares when the price is lower. Okay, so that's the demand side of the equation. What about the supply of assets? Well, in the short term, the supply of shares of stock for any company is basically fixed. Now, it's true that companies can issue new shares to increase the supply, or they can repurchase old shares to decrease the supply of available shares. But these adjustments are often slow and take time. So in the GameStop episode specifically, GameStop waited until a week ago, Monday, April 5th, to finally announce that they intend to issue new shares. And so throughout January, February, and March, the supply of GameStop shares was fixed. Okay, so with these building blocks in place, now graphically, we can illustrate how prices might spiral out of control in this example. So what's plotted here is called an inverse demand function. It's the inverse demand function for our all-in investor. What we have on the y-axis is the price of a share of stock. What we have on the x-axis is the quantity of shares that this investor will purchase. You could think of this as being the number of shares. This is their demand for shares. So remember, when the price was $100 per share, our all-in investor bought 12 shares. When the price doubles from $100 per share to $200 per share, our all-in investor buys 18 shares, 6 more than they bought before. If the price had instead tripled, the all-in investor buys 20 shares. And so this curve represents how many shares our all-in investor is going to buy at every possible price for this stock. Our value investor has typical downward sloping demand. When the price is very high, it's higher than the fair value. Our value investor wants to sell shares of stock or engage in short selling like Melvin Capital. This corresponds to a negative quantity. They have a negative demand. They want to buy a negative number of shares. The way you buy a negative number of shares is that you sell shares of stock. So our value investor is selling shares of stock in this case. When the price is much lower, so at $200 a share, they're selling shares of stock. At $50 a share, the price is less than the fair value. In this case, our value investor wants to buy shares of stock, and so they have a positive demand. They demand a positive quantity of shares. And importantly, as the price gets lower and lower, it's further and further away from the fair value. This means that our value investor thinks this is a really good investment, and so they're going to buy many, many, many more shares. And so we get a typical downward sloping demand function. The lower is the price, the better the deal that I'm getting on those shares, the more shares that I'm going to buy. So we have two types of investors: all-in investors who have upward sloping demand, value investors who have downward sloping demand. Total demand for assets, the total number of shares that the combination of these two investors want to buy, is just the sum of these two lines. Now, there's two features of the total demand that I want to point out. This curve for low prices is upward sloping. So if the price is around $50 a share, we can see that the demand curve is upward sloping. And it has a very similar shape or a very similar slope to that of our all-in investor. When the price is high, more than $200 per share, the demand curve is downward sloping, and it has a very similar shape or very similar slope to that of our value investor. So for low prices, our total demand is upward sloping. It seems to match the features of our all-in investors. For very high prices, the demand curve is downward sloping. It seems to match the preferences or features of our value investors. Now, if we want to think about at what price should this share of stock trade, we now need to introduce the supply, the number of shares that are available to purchase. And we think that the price will obtain where the market clears. That is where the number of shares that investors want to buy is exactly equal to the supply of shares that are available for them to buy. The key feature of our supply curve is that, as we said, in the short term, in the case of GameStop in January, February, and March, the supply of shares is fixed. So regardless of the price, whether the price is 100, 200, or 300, the supply of shares is always the same. And in this example, it looks like it's around 15 shares. So the supply of assets, supply of shares is fixed at 15 shares. As we increase the price, all-in investors would like to buy more shares. Value investors would like to buy fewer shares. Now, the interesting feature of our model, or of this theory, is that there are two prices at which the market clears, at which the demand for shares is equal to the supply of shares. The first is the initial price of $100. So one possibility is that the price can stay fixed at $100 per share, like it was originally. But there's a second price which also clears the market, at which demand also equals supply. And this is a higher price of $165. So without any change in fundamentals, the price can jump from $100 per share to $165 per share. And this can start the price cycle that we have in mind. All right, so let me just quickly summarize what I tried to show graphically. So first, because some traders are all in, aggregate demand for shares, the total demand, that solid red line on the previous slide, is upward sloping at a price of $100. And it's upward sloping because our all-in investors have upward sloping demand. And what this implies then is that the price of the share of stock, which started at $100, can jump up from $100 a share to $165 a share without any change in the fundamental value of the asset. And the way this works is as follows. At the new higher price, the all-in traders have more wealth. Because they borrow to increase their buying power, when the price increases, they become wealthier. And they become more wealthy, they become even wealthier than the increase in the price. And this means that they buy more shares. So at the new higher price, our all-in investors buy more shares. They go from 12 shares to 16 shares in our example. But this increase in demand from all-in traders is exactly offset by a decline in demand from our value traders. So the all-in traders buy 4 more shares, the value traders buy 4 fewer shares. And so demand and supply remain equal. There are 2 prices that we think this stock could be. The stock could be $100, and then instantaneously it could jump up to $165. The only thing that changes is that 4 of the shares that were owned by value traders are sold to our all-in traders. And this previous argument can be repeated again and again and again. At the new higher price of $165, our all-in traders own more shares. They now own 16 shares. And this means that their wealth and therefore their demand is going to increase now more quickly as prices rise. So if I own only 12 shares and prices rise, that's going to have some impact on my wealth. But if I own 16 shares, 4 more than I had before, now an increase in price is going to increase my wealth even more. When I own more shares and the price increases, that makes me better off, or even more better off. And since our all-in traders therefore have more upward sloping demand when they own more shares, 16 rather than 12, this is going to mean that aggregate demand, total demand, is also more upward sloping when our all-in traders own more shares. And this logic is going to imply that the price can then jump yet again, and I'll show you this on the following slide. And it turns out that at every higher price, this same process can be repeated. All-in traders acquire more shares, demand is upward sloping, and the price can jump. Value traders acquire more shares, demand is upward sloping, and the price could jump. Unless trading is restricted in some way, there's no limit then to how high prices can climb. And this is particularly pertinent to the GameStop example. In late January, the price seemed to rise more and more each day, as our theory suggests. And the only thing that prevented or stopped the rise in prices was when Robinhood and Interactive Brokers prevented these all-in traders from buying additional shares of GameStop. And so it took a restriction of trading in the GameStop episode to stop this price cycle from continuing to rise. And here's this argument just graphically. So this pink line here is the total demand curve from before. This is the demand curve when our all-in traders owned 12 shares of stock. After the price jumps from $100 a share to $165 a share, our all-in traders now own 16 shares of stock. Because they own more shares, demand is more upward sloping than it was before. And so the new total demand curve is now this reddish orange line. If we add in the supply, we can see that there are again 2 prices where the market clears, where the demand for shares, the number of shares investors want to buy, is equal to the supply of shares, the number of shares that are available for purchase. So the price can jump yet again from $165 per share to $281 per share. At the new higher price, all-in investors own more shares. They own 22 shares now. That means that our value traders own fewer shares. They own 6 fewer. And we have another place where demand is equal to supply. If we zoom out, we can add a third demand curve, and you can see how this process can repeat over and over and over again. If the price jumps from 165 to 281, our all-in traders now own 22 shares, 6 more than they owned before. That means that the new demand curve is even more upward sloping than the old demand curve. There are again 2 prices that we think the share of stock can obtain. The market clears at the original price of $281 per share, but the price can also jump up to $491 per share. We could draw a 4th and 5th and 6th demand curves. And again, there's no limit to how high prices can get in this case. All right, so let me just very quickly conclude. So the takeaway from our model or from our theory, our explanation for what has happened in GameStop, AMC, and others is that when enough traders are all in and they have access to enough margin, what we've shown is that prices can escalate rapidly. And again, this can happen without a change in fundamentals. So we titled this webinar, Why GameStop, Why Now? We can now use our theory to answer those questions. So first, why GameStop? And our answer to why GameStop is because we need enough traders. So the fact that these investors on Wall Street bets were able to coordinate on one single stock is what's primarily important in this episode. And the success of Roaring Kitty and some of these other early investors that pointed to GameStop is what allowed these investors to coordinate through Wall Street bets. Once we have coordination among these disparate small all-in investors, we have enough traders to set off a price spiral like this. And the answer to why now is, well, we need enough margin. So these types of all-in investors need to have access to borrowing. They need to be able to borrow from their broker or buy options. And only recently, within the last 5 or 10 years, have Robinhood and other trading platforms given access to these types of investors, given these types of investors access to margin and options trading. So you really need these two forces to be at play. You need coordination through social platforms like Wall Street Bets, and you need the ability to buy on margin through Robinhood and other online brokers. When these two things happen together, you can get price spirals according to our theory, our explanation. What stock could be next? Unfortunately, it's really hard to say. And the reason is that coordination is what's first and most important. And traders can literally coordinate on anything. So trying to predict back in 2018 which stock traders were going to coordinate on in January of 2021 would have been nearly impossible. And so anything that starts this coordination mechanism could potentially lead to the next price spiral. We can say one thing, though. We can think about the types of companies that would be possible to see similar price spirals. And in the context of our theory, the next company must be large enough to have traded options. If they don't have options, then our investors can't get enough leverage. They can't have enough borrowing capacity in order to set off a price spiral. But the company can't be too large. It has to be small enough that our all-in investors can affect prices. So if you thought about trying to coordinate to generate a price spiral in Apple, for example, it would be pretty hard to do that. What we need is that when prices rise and these all-in investors demand more shares, that this feeds back into a meaningful change in prices. Depending on the number of traders who are trading on this stock through Wall Street Bets or coordinating to trade through Wall Street Bets, they may or may not have enough purchasing power to nudge prices in a stock like Apple. And then finally, is this a money machine? Is this the way we should all be investing going forward? Our answer is no, or not necessarily. In the context of our theory, our explanation generates substantial paper wealth. So in particular, these all-in investors, they continuously reinvest their profits back into the stock. And so all of their wealth is tied up in the stock that they own. None of that wealth is in cash that they can use. Once these all-in traders are no longer all in, once they decide that they want to sell their shares of stock, this is going to unwind the cycle and the price should plummet. So some early investors may be able to exit at a large profit. Roaring Kitty certainly made a large profit on his trade, but large investors like Melvin Capital or other hedge funds, investors who are late to the game are unlikely to be able to turn their paper wealth into actual wealth, because once they cease being all in, the price cycle ends and the price should return to its fair or fundamental value. All right, so that is all that I have. Thank you again for the opportunity to present our research, and thank you to everyone who attended. I will now turn it back over to Laurel and to the audience and take any questions that you might have.
Thank you, Brian and Ed. As a reminder, if you have any questions, please submit them through the Q&A interface located at the bottom of your screen. Our first question is, do you feel the growing organizational power of social media will affect long-term value investing strategies?
Certainly, as we saw here in our explanation, social media is a key driver of these price cycles because you need these all-in investors to coordinate on a small number of assets. And so this could very well affect the opposite side. In our model, in our explanation, we have two types of investors, all-in investors and value investors. And in the context of our model, the value investors lose substantially as the price spirals upward because our value investors continue to take larger and larger short positions. And so I wouldn't argue that value investing is no longer the right strategy or that value investors are doomed in the future. But if you are on the wrong side of one of these price spirals, then you can imagine that this would be problematic for you as a value investor. And in addition, as you mentioned, or as the question asked, social media, at least in the context of our theory, is a key driver of these types of spirals in the future because you need enough wealth among all-in investors to be targeted to a small number of securities.
Thank you, Brian. Our next question comes from Tim. Is there a relationship between increased share price volatility and the influence of ever-increasing ETF holdings? Do ETFs effectively reduce the available float?
Thanks for the question. I would say that's a little bit outside the model. So our model specifically doesn't necessarily have anything to say about that. I'll just mention it's worth pointing out ETFs do have differences between traditional index mutual funds, but all of these things would reduce not the public float, but they would reduce the number of shares available to be traded among others, certainly. I think you would have to ask the question, if you have somebody who invests $1,000 in an ETF, what would the person do if that was not available? Presumably, invest in other shares that the ETF would make available, which would sort of reduce the shares available for everybody else similarly. But all of this is a little bit outside the model, so I'm not sure we speak to that.
Thank you, Ed. Our next question is, since short interest is self-reported by all these hedge funds, do you think that short interest is higher than it actually is right now, or how accurate do you think the short interest is?
That is something we haven't studied. I mean, hedge funds do have to report accurately on a quarterly basis, but not necessarily on a day-to-day basis. I'll say this, though, in the context of this model, if you're going to be short, you got to be real careful. So we didn't talk about it, or Brian didn't talk about it in the presentation. If you're interested, there are other things in the paper that we didn't really get a chance to talk about. But the model suggests that prices can sort of jump up very, very quickly and repeatedly. But the same force doesn't work in the other direction. You don't just get this jumping downward due to all-in investment. And so I think if you are going to be short, it's a scary thing. My suspicion is that there are a lot of people who are currently short who are offsetting those positions with call options or something like that. Again, this is outside the model. We haven't looked at the data. I certainly haven't looked at how hedge fund reporting has worked. But I think you got to be real careful if you're short on stocks like this right now.
Thank you, Ed. Our next question, our next question comes from Kelly. As you know, GameStop is considering issuing more shares. Is it possible that in the event a company could issue shares quickly in response to all-in investor demand, the company could both be a benefactor of the all-in investors' purchases and prevent the all-in investors from distorting the price to also benefit value investors?
Yes, so I think that's a great question. So certainly, if you can increase the supply of shares, that will typically an increase in supply leads to lower prices rather than higher prices. And so if the number of shares quickly increased, then that would prevent some of this upward pressure on prices. That would decrease the number of new shares that the all-in investors take, and that would certainly mute the price cycle that we have in mind. It would certainly also be beneficial for the company, right? If the price gets bid up above the fair value, whatever that might be, it is certainly in the company's best interest to issue shares and to take advantage of the ability to sell and raise capital at favorable prices. I think one thing that's interesting, this is unrelated to our model, but typically when a company issues shares, there's a fairly strong negative impact on the share price. And this is because it's seen that the price is too high. Otherwise, why would the company be willing to issue shares? When GameStop announced last Monday that they were going to issue shares, the price did not go down as it typically does. They were able to issue shares essentially at the current going market price. I don't know why that would be the case, but that's something to think about in the context of our model, is what happens if companies do have the ability to issue shares, what happens to the price spiral, and is this a way that you can prevent from happening? And it's also very clearly beneficial for the company. Being able to raise money at very high prices is good for the investment prospects for the company.
Thank you, Brian. Our next question comes from Reed. Is BTC in a price spiral? Does leverage access prevent this?
I think we didn't really talk much about Bitcoin or any of the other, similar assets. An interesting thing is that they don't have any fundamental value. So at least, and this is my own view. Obviously, there are a lot of people who have a very different opinion about this. But if we were to say, is Bitcoin overpriced or underpriced? You would say, relative to what? I mean, if it was half the price or double the price, I mean, it's not like there are any cash flows being provided. It's not like Bitcoin might go bankrupt. It's not like it, there is no fundamental value of it. What that means is that you don't get these sort of value investors, I don't think, that you get in our model, who really are pinned down to what the thing is truly worth in the long run. You could imagine that every investor in Bitcoin is all in. I mean, you could imagine all sorts of investment behaviors for Bitcoin that aren't tied to any particular value investing strategy. And at least to my mind, it suggests that, sure, the price could double, it could triple, it could go up tenfold, and there's nothing really stopping that. It could also fall to zero, if everyone just decided they didn't want it. But I do think that if you get enough investors following this all-in strategy, then you could get Bitcoin jumping up quite a bit more. Now, access to leverage is a different story. You're not buying Bitcoin through a traditional margin broker that's lending you money at 10% a year to sort of buy on margin. And so limits on leverage would reduce the applicability of the model. That said, the leverage that you need in our model for spiraling to occur, which is you need leverage of at least 2 to 1, which is another thing we didn't mention in the talk, but is true. I don't think you would need that for something like Bitcoin because you may not have any value investors in it.
Thank you, Ed. Our next question comes from Jonathan. Based on what you laid out, the price of GME can go even higher. And if so, what events could trigger it?
Right, correct. So there is no limit to how high the price can get according to our model. What you need is these investors to exhibit this all-in behavior, to be willing to constantly reinvest the profits that they have as the price rises. That seemed to be the case in early January. If you followed the Wall Street Bets forum, people were speaking in this way. They weren't just talking about holding their position, they were talking about increasing their position whenever possible. So I think the reason that the price may have somewhat plateaued recently at a still very high level relative to where it was in early January is that some of these traders who got potentially burned by the dip in the price following when Robinhood shut down trading are no longer willing to constantly reinvest. and they're willing to just hold their position. So, right, it's not enough to just hold your position in GameStop. For a price cycle to happen, you need to be constantly increasing your position as the price rises. And so what we would need for this to take off again or to continue to skyrocket would be to see that kind of behavior really take back up at a really high level. What kind of events could have that happen? I'm not really sure. I think it would take another roaring kitty to get the momentum and the fervent behavior going about, look how much money I made. And there was really this, at least during the short squeeze part, it was a really, us against them kind of mentality, where as the price was rising, it wasn't just about making money, it was also about making sure the hedge funds lose money. And you need that kind of mentality, I think, to justify or to incentivize this all-in behavior at the level that you need for the price to really get back up to, let's say, $500 a share like it was previously.
Thank you, Brian. We're going to move into our final two questions. Our first one comes from Thomas. We have seen media impact investors' decisions in the late 1990s with emergence of CNBC and other outlets. Why is this different?
Let's see. So different in the sense that it's social media versus media, I guess would be the question. I mean, all you need is some coordination device that gets, a lot of these smaller investors to agree to be all in. And as Brian said in the last example, they can't actually in aggregate just be diamond hands. They need to be all in. They need to be like that chimp in the meme who is increasing his position as the price went up. So could this have happened before? I think it could have. I mean, when I think of classic pump and dump schemes, which go back, they go back to the 18th century. The classic pump and dump is you buy a stake and then you encourage everyone else to buy stakes to get the price to go up, and then you sell your stake. But this really was a different thing where people were continually increasing their stakes, as Brian said, to stick it to the man. I'm not sure that classic pump and dumps had that strategy of getting people to constantly grow. They were just trying to get investment. Brian,
Yeah, and let me just add one more point. It's totally possible that it could have happened with just CNBC and public media, except that these investors did not have access to margin and options trading 20 years ago, right? So the type of investor who was posting on Wall Street Bets and may or may not have been the same type of investor who was watching CNBC would not have been easily able to borrow 2-to-1 in order to increase their buying power. And then their wealth would not have increased faster than prices, and you can't get a price cycle without that feature as well.
Thank you, Brian. Yeah, absolutely.
Thank you both. Our final question comes from Saul. How much effect do the call option prices affect the model? For example, how did the March of last year price call options of $30 compare to that of an $800 call option today?
Yeah, we didn't really talk about it much, but that's a great question to finish on. So here's how, at least I think we think about all-in investing actually taking place. Imagine that the stock is $20 a share and you have call options with a strike of $30 a share. Those options might cost $2, if the volatility is low, for example. Those options give you the right to buy at 30 at any time before the option expires. So if the stock price goes above 30, they start becoming worth something very quickly. So imagine the price goes from $20 a share to 40 as those options are expiring. So those options are now worth $10. You bought them for $2. The investor who's now just quintupled her money might sell those options, buy new options that expire a month later at $50 a share. Those options might cost $4 each. Well, she's turned her, $2 an option stake into a $10 an option stake. She can roll that over now into these $4 an option stakes and have 2.5 times as many options as she had before. And as the price goes up, she can just keep scaling up her options positions in this way. So all-in investment behavior doesn't necessarily involve buying on margin. Just sort of rolling over your options behavior, your options positions as the stock price goes up will inherently increase the number of options that you hold as the price goes up. All-in behavior is essentially inherent to just rolling over your options position. So it really is critical that regular investors who previously had restrictions to their options trading ability had those restrictions lifted by brokers. Brian is absolutely right to bring that up as separate from the 90s. That really is sort of critical to allowing this spiraling or ratcheting process to occur.
Thank you, Ed. And thank you so much for everyone for joining us today. And again, a big thank you to Ed and Brian for this great information. At this time, we invite you to provide your feedback on the webinar by entering the following poll question. On a scale from 1 to 10, how likely are you to recommend this webinar to a friend or other CU Boulder alumni? We thank you in advance for submitting your feedback. As a reminder, all webinar attendees will receive an email tomorrow with a link to the recording of this presentation, as well as a survey. To view upcoming webinars, as well as previous recordings, please visit our website at www.colorado.edu/business/alumni. We hope you will join us for our next webinar, which is Friday, as Dr. Tara Tanksley presents on death, discipline, and digital resistance, how Black youth leverage technology to survive and resist anti-Black racism. In the meantime, have a great rest of your day. Thank you for your time, and go Buffs.